Good afternoon, everyone. Sorry about that. I couldn't find the right button. We are about to hear from Stefan Gries at BlackRock Greater Europe. Um, BlackRock Greater Europe is an unusual trust which offers exposure to equities across the European continent, including the developing economies of Eastern and Southern Europe. The trust is managed by Stefan, who runs the majority of the trust assets, and Sam Vecht, BlackRock's head of global emerging markets, who looks after a small allocation towards developing markets in Europe. Stefan joins us here today to talk about the trust and the outlook he sees for continental Europe at this quite fraught moment in its history. And I'm delighted to hand you over to him now.
Good afternoon, everyone. It's an absolute pleasure to be with you today. I hope everyone is keeping well. Just to introduce, my name is Stefan Gries. So I'm Deputy Head of the European Equity Team at BlackRock and also Lead Portfolio Manager of the BlackRock Greater European Investment Trust. And we were going to use the time we have with you today to share some thoughts on the current market environment in European equities, where we see the most compelling opportunities. And in that context, we'll talk about some of the exceptional businesses listed in Europe that should do well, regardless of what happens in the European economy more generally. Okay, it's fair to say the start of the year has been very different from what most market participants, including ourselves, had expected. We entered the year expecting to see normalization of growth, post a strong recovery in earnings in 2021. And with that normalization in supply disruptions and inflationary pressures easing. In reality, as we know, return outcomes since the start of the year have been pretty extreme and were impacted by a number of factors like more hawkish central bank action, the war in Ukraine, the energy crisis that resulted from this, and broad-based fears of economic slowdown. Now, this has led to negative returns for both equities and bonds, and the first half for the S&P 500 since the early 1970s. But what's more relevant for us as investors in Europe is the significant shift we have seen within the market from growth to value stocks, which we were showing on the chart top left. And you really have to go as far back as the global financial crisis to find a move of this scale, which clearly has inflicted pain on portfolios and led to significant derating of some of the best businesses listed in our region. Now, we have seen many of those rotations over our careers. Initially, they can be caused by a relative repricing of valuations as real yields move higher. But in our experience, those shifts can only be sustained if fundamentals of companies eventually back up those moves in share prices. Or to put it slightly differently, in the short term, you can have changes in the level of interest rates, moving shares, but over any meaningful time frame, the medium to longer term, it is relative fundamentals of businesses and industries that will determine return outcomes. And what gets us interested today is the fact that through all of these factors coming together, we have seen ownership of Europe at record lows. Sentiment towards the region is extremely bearish, which has also resulted in valuations at record lows relative to the US, which we're showing on the top right. And this also holds true for some of the best businesses Europe has to offer. Now, this is showing what we just talked about in a slightly different way. What we're showing here is a return decomposition of different subsectors of the Stoxx 600, quite a broad European market index. And there are really two observations to make here. Firstly, with the exception of travel and leisure and the retail sector, we can almost explain the entire move in share prices year to date by multiple derating rather than downgrades to earnings and dividends. And this is also true for our portfolio holdings, as most of the companies we own have continued to report strong earnings and often upgraded guidance for the year as we went through the first half, and still saw their share prices decline and that's in many instances as the market was worried about the economic slowdown. And by the way, when we speak to companies today, many of them are still not seeing a material deterioration in demand or in their order books. And this is obviously very sector dependent, but it's definitely an interesting feature and one of the reasons why it's very important to stay selective in this environment. The second observation would be that if we look at share price outcomes over a 3-year period, the overall moves seen can now almost be entirely explained by growth in earnings and dividends that companies have enjoyed, which again points to the de-rating we have seen, which leaves many assets quite attractively valued in our mind. Now, we put these tables in as most of the current market debate centers around when inflation is going to peak and how severe this slowdown is likely to be. And we also wanted to point to a few positives that are maybe slightly overlooked. For instance, when we look at corporate and household balance sheets, we believe they are in decent shape and, importantly, in a much stronger position compared to the start of previous downturns. Top left, you can see how corporate balance sheets have deleveraged over recent years. Basically, corporates have spent over 10 years deleveraging their balance sheets, and interest coverage sits at record 18 times today. And just for comparison, this number was 3 to 4 times in the second quarter 2008. On the top right, we see that spending intentions remain relatively healthy, and this spend is often linked to transformational capex on areas like digitalization, reshoring of supply chains, or the energy transition. And as far as consumers are concerned, we all know many Western economies are currently facing labor shortages, which is keeping employment at record levels, wages well supported, and leaving households with higher than average savings, which should provide some cushion for the squeeze in disposable incomes that is undoubtedly occurring right now. Now, lastly, when it comes to the outlook for consumer spend more broadly, we also shouldn't forget that governments across Europe are doing their bit to partially protect households from some of those most severe cost pressures. Now, another positive for future capex spend that is kind of coming from this current situation, where Europe is clearly the most negatively impacted by the energy crisis, is the fact that this creates an even greater urgency and determination among European politicians to accelerate the energy transition and reduce dependency on imported gas into Europe. Now, Europe had long been leading the world with its environmental and sustainability policies. It is clear to us from many conversations with companies that the tragic conflict in Ukraine is likely to bring forward spend that otherwise would have happened only during the second half of the decade. And the good news here is that as investors in Europe, we can capture those strong secular investments through some of the companies we own in this trust, as they're leading in areas like improving energy efficiency of buildings, renewable fuels, or decarbonization of transport and the shift to electric vehicles, which are all areas Europe has decided to direct its spend towards. Now, to be absolutely clear, we are naturally skeptical when it comes to the impact those type of fiscal programs can have on earnings and cash flows of businesses we own. But when we look at both the European Green Deal and the European Recovery Fund in a bit more detail, we find sizable investment plans and a large part of the spending going towards climate initiatives, with particular focus on renovation and refurbishing of the existing building stock, as well as investment into digital transition to make the European economy more competitive. Now, for the region, this creates a bit of a cushion while global growth is clearly slowing down. And for our companies, this means that some of the long duration income streams we were already aligned to in the portfolio have the potential to be enhanced even more by this investment coming through from the European Union. Now, with this in mind, it's important to be clear about the type of asset we look for and we own. As you know, Europe is home to over 2,000 listed companies, and quite a few of those businesses are actually global leaders in industries they operate in, which is why we've often made the point that we don't necessarily have to have a positive view on the European economy to be a shareholder in this trust. It's important to remember that listed European equities generate only up to 40% of their revenues from the region, and the rest comes from global sales. So many of the businesses we own should do well pretty much regardless of what happens in Europe more generally. And that's because when we pick those stocks, we apply some very strict investment criteria. As our companies typically run by exceptional management teams with a clearly defined strategy for value creation, it's companies earning a high return on the capital they invest, and importantly, they generate a significant amount of cash, which provides them with plenty of optionality to deploy capital at high returns in attractive growth projects, which in our mind is how you create value for shareholders over time. And when we step back for a moment and think about the environment we're in right now with high inflation, supply chains disrupted, and a multitude of other cost pressures, we would argue that this environment has been the ultimate test for management teams of the companies we own. And this is why we pay so much attention to those management qualities and invest in businesses that have pricing power, that have scale and procurement, and a strong track record in managing their supply chains. Now, when we think about wealth creation more generally, what we aim for is to carefully select businesses that tap into end markets and income streams that lend themselves to value creation on a duration basis. And we can say that the volatility over these last few months has given us some opportunities to selectively add to some of those businesses that were affected by the market sell-off, despite their medium to longer term fundamentals remaining strong. Now, maybe I'll just repeat that point. For the long-term investor, volatility creates opportunities to buy assets that have the potential to create significant amounts of shareholder value at much lower valuations. Right now, we often get asked how all of this is going to end with heightened geopolitical tensions, inflation staying higher for longer, and central banks aggressively tightening into slowing economies. We'll raise our hand to flag we don't have a crystal ball either, and near term, the environment clearly remains incredibly uncertain. One positive for us is that those factors have been reflected in valuations to quite a large degree already, and positioning and sentiment are extremely negative right now. Now, what we do have a high degree of confidence in is that some of the long duration income streams we are invested in will see accelerated investment timelines, and that should result in that attractive growth at high returns. We have listed a few of those income streams on this slide. And yes, as investors, we all might have to concede that the regime of lower for longer inflation and rates that we all got used to is likely gone for good. But what hasn't changed is the way the world is changing around us. And those trends are really very powerful and unlikely to be disrupted or stopped by a higher level of interest rates. Now, we mentioned some of them earlier already, but it's clear we will see much faster investment into decarbonization and electrification of the European economy. This includes making buildings more efficient, refurbishing the existing building stock, where you reduce not just energy usage, but also emissions. For instance, did you know that the existing building stock in Europe accounts for about 40% of all CO2 emissions? So this is a huge opportunity, not just to save energy, but also to reduce our carbon footprint. Transport is likely to be decarbonized even faster than originally expected, which should benefit some of the enablers of that shift from combustion engine cars to electric vehicles, which we own in the technology sector. Well, these are all trends we can capture through portfolio holdings. And what is exciting to us is that many of those changes are triggering large transformations of industries that we haven't really seen before in our careers. And in many cases, we are only in the very early stages of those transformations. And it's really our job as stock pickers to identify the winners and losers of that change. Now, a good example of a winner of Europe's future investment into its building stock is Swiss-listed Sika. Sika is a global leader in construction and industrial chemicals. It provides solutions for sealing, insulating, bonding, as well as protecting load-bearing building structures. Its products are often used in large infrastructure projects, which positions it very nicely to capture some of the trillions of dollars we are seeing in post-pandemic infrastructure spend globally. Now, the company is also a bit of an innovation powerhouse. It has a very well-diversified and innovative product portfolio, as well as a powerful distribution network across all of the regions it operates in. And Sika operates in over 100 countries, so really very diversified in that way. And on the construction side, where Sika products are being used, it can really drive material cost savings for its customers by improving workability of materials like concrete, while at the same time materially reducing water usage. But more importantly, for Sika, the refurbishment and modernization business already account for 50% of total sales. And this contribution also comes at much higher margins, which leaves it very well exposed to some of these initiatives coming out of the European Green Deal. And when we look at Sika's end markets, we can see they're still relatively fragmented, leaving plenty of room for the business to continue to take market share and to significantly outgrow the market. And finally, the management team here has an excellent track record, and we expect them to continue to deploy capital in a way that allows for margins to expand further and for the return on invested capital to move into the high 20s over the coming years. So overall, we see a long run rate of value creation ahead for Sika shares. Now, Hermes is another example of a business we own. It probably best fits the title of today's event. In our mind, this stock absolutely belongs to a select group of companies that we would classify as European royalty among listed assets. It's unrivaled when it comes to the provenance and heritage of its brand and product portfolio and the pricing power that comes with this. And its most profitable division in fashion leather goods. It takes up to 5 years to train a craftsperson to build the various different handbags and leather goods by hand. And it's the only company we know that enjoys up to 4-year waiting lists of its iconic handbags, like the Birkin bag, which can retail at prices well above $4,000, depending on the material used. So this company actually finds itself in a situation where it can't keep up with the demand as its capacity can only grow by 6 to 8% per year. And that means many of the unique MS items that are shipped to a relatively small global store base will be offered only to a select few clients. It's a beautiful business model where, as a client, you're basically invited to buy the most original and iconic pieces. And if there's weakness of demand in one region, like we had in China during lockdowns, you can simply reallocate that product to another part of the portfolio, to another part of the world. Now, this business is also family-owned. The family owns 2/3 of the company, and the group, as a result, has been run in a conservative fashion for generations. The brand is over 200 years old, and the family only takes decisions with the very longest of time frames in mind. And what is also done is proven exceptional resilience in downturns, and that's because its clients are typically less sensitive to weaker economic environments. Now, if you take all of that together, this gets you to a company that generates a 70% gross margin, close to 40% EBIT margin, 25% return on invested capital, which when you combine that with a top line that has the potential to grow into the double digits, makes for a very powerful combination. Now, our last example of a unique business that is listed in our region is Swiss-listed Lonza. Lonza is a global leader in contract manufacturing of high-end biological drugs, as well as cell and gene therapy, and latterly the development and production of vaccines. In this capacity, Lonza produces drugs for the likes of Bristol Myers, Roche, Sanofi, in contract structures that are often 7 to 10 years in duration. And given the complexity of the production process, there are only a handful of companies that can do what Lonza do, and the barriers to entry are protected by the fact that production facilities generally have to be certified by the regulator in the US, the FDA. We expect Lonza's biologics business, which is the highest margin part of the group, to remain a proper growth engine as we see it grow in the mid-teens over the next 10 years. And what we particularly like here is that any incremental capacity they build is likely to earn a return on invested capital of close to 30%. Now, pricing is another positive, as there's generally a shortage of capacity in the market. In fact, management recently communicated to the market that pretty much all of Lonza's global production capacity is sold out for the next 4 years, which is not only giving it real pricing power, but also provides strong visibility on its earnings trajectory overall. Now, in our team, we have a saying that goes that good things can happen to companies that have pricing power. Lonza is one of those companies, which means that any growth they deliver should be strongly value-enhancing growth. Now, let me now briefly touch on some of the main features of this trust. Our investment objective is to deliver long-term growth in capital for our shareholders. In order to achieve this, we look at that addressable universe of over 2,000 listed companies, and we bring this down to the 35 to 45 most compelling investment opportunities that Europe has to offer. Now, that means we build a relatively concentrated, high conviction portfolio that invests in some of the best businesses listed in our region. And currently, we are at about 35 holdings in the portfolio. Now, our job is to carefully construct this portfolio of what we deem to be wealth creators, companies that often dominate their respective markets. But ultimately, our approach to running this trust is that once we have identified what we believe is a winning franchise in Europe, we build conviction positions that we size large, and we run them to let that value creation come through over time. In fact, if we had to point to a recipe for wealth creation, and we keep it very simple, but the recipe that should yield the most attractive returns over time, we would point to 3 key ingredients, and those are high returns, growth, and time. And we're always surprised by how little time investors allow management teams to actually execute on the strategies they've laid out. Now, we aim to be longer term owners in businesses and in this trust. And by that, we mean that we target average holding periods of at least 3 to 5 years. Many of our holdings we've actually held for much longer than that. But even in a rather tumultuous year like 2022, our fund turnover year to date only amounts to around 10%, which is actually implying much longer holding periods than the one we target. And it's a very, very consistent way of running the strategy. Finally, as was mentioned at the beginning, we also need to point out that we can run a small allocation to emerging European assets, which offer access to often some very attractively valued and fast-growing companies too. Now on this slide, we wanted to give you an idea of how the trust is currently positioned. We are showing you here our top 10 positions as per the end of August. Now, one feature you should expect within a concentrated and high conviction portfolio is that our top 10 positions at any given time will account for up to 45 to 50% of fund assets. What matters to us is that we want to make sure that within that top 10, we tap into as many different end markets and income streams as possible. This means that while we run a relatively concentrated fund, we source earnings and cash flows at the aggregate portfolio level in multiple different ways. And what we're aiming to do in the process is to target diversified sources of alpha with outperformance, hopefully coming from many different parts of the market over time. And if we again step back and think about what we're trying to do, one of the best parts of our jobs is to identify winning franchises early, like we did in Lonza when we first invested in it in 2015. When it was hardly covered by anyone in London, the business was relatively undiscovered, which all changed over subsequent years. And if we execute well on that, and I can tell you at BlackRock, we do about 2,000 company meetings per year just in our team. So we turn a lot of stones, but it means that we can grow with those businesses over time and share in their value creation over the years to come. And then lastly, we've got this slide on performance. And when it comes to performance, we strongly believe that we can deliver the best results for investors in our trust over the medium to longer term. If you cast your eyes over those 3 and 5 year numbers, you can see our share price outperformed its benchmark by just under 10 and 29% over those periods. Year to date has clearly been more difficult, but for us, periodic drawdowns are what we do expect in a strategy like ours, where the focus is firmly on producing growth in capital over the medium to longer term. What these numbers show overall, though, is they kind of highlight the importance of taking an active approach to investing in European equities, and they show the benefits of adopting that long-term approach where we put owning businesses over trading in shares. And with this, I already come to the end of the presentation, so we can hand it back to the moderator and open it up for questions.
Hi guys, so yeah, we have a few questions here. Hopefully my camera is now working. First one is, it's quite a sort of broad question, but how defensive is the portfolio? And I guess that is triggered by what's going on in Europe at the moment. How resilient is the portfolio, and in what way is it resilient?
Yeah, so I guess the first observation that would be that typically, we make use of some of the trust features where, if we think the opportunity is right and the opportunity set is right, we apply gearing. Right now, we're actually running a small cash position, and that compares to us being probably at least 6 to 8% geared, on average in the prior 4 to 5 years. So we have taken that gearing off, which makes the portfolio more defensive. And then if you think about the companies we own, again, it's a function of, I guess, what we think we've got the portfolio aligned to in some of these longer term trends and income streams. We think that the companies that we invested in more generally will have the potential to outperform the market. What we've seen year to date, and this is coming back to what I was talking to right at the beginning of the presentation, is a significant derating. And I guess that is quite hard to model and quite hard to forecast, and that has inflicted a little bit of pain on the portfolio. But we think that the majority of that has now kind of been done. The pain has been taken, and from here, it's again more about the outlook for earnings. And while clearly the world is slowing down, we feel well positioned in the companies that we own in the trust because they typically have something slightly unique about them. They have that pricing power, and they often have some secular drivers that will help them to grow faster than the market overall, even in a slowdown scenario.
Thanks. Can you talk to us about the dividend policy as well? Because I gather there is a progressive dividend policy in place, even though the trust doesn't actually target income in the underlying companies.
Yeah, no, that's correct. The dividend is really important, and to the board, to us as managers as well, and it gets reviewed on an annual basis, by the board, and we typically try to grow the dividend as well. So that has been a recurring feature of the trust overall.
What proportion of the portfolio revenues are generated within Europe domestically?
To be honest, it'll be probably even slightly lower than the number I quoted, earlier. So a lot of the companies we own have a very large proportion of their revenues coming from outside of the region, which is why I was making those comments. Often quite global in terms of their remit. I was talking about Sika operating in over 100 countries. If you take something like some of the other companies we own, I always have to be careful on these calls because your inclination as a stock picker is to immediately talk about your whole portfolio, but there's only a limited number of stocks we're actually allowed to talk about. But the comment stands that on balance, our companies source a lot of their revenues and earnings from their global operations, and then you have some parts of the portfolio where it's clearly more domestic. For instance, in financials, where we recently added to some of our banks positions, and they're obviously more domestic in nature, but we see a very strong fundamental backdrop there, and earnings upgrades coming through at very cheap valuations as well.
And I guess tied to that question is how sensitive is the portfolio to the fortunes of the dollar? And does that have to come into your decision making when you're engineering it?
Yeah, I mean, we obviously look at this, and it's a very fair question for a lot of our companies. The dollar is a reasonably important component. US dollar revenues, whether that's in luxury and in some of the luxury companies we own, but also again some of the other industrial companies or even healthcare. Over time we find it comes out in the wash. Clearly, right now it's been a big positive, and to be honest, we don't think it's been fully reflected in the earnings forecasts yet, because what you find is that analysts are typically upgrading their forex assumptions only with a lag. So we actually think this is a positive over the coming few quarters, as and when those models get updated, because it's clearly a benefit coming through from currency right now.
Another question here is about unquoted stocks. And a lot of the sort of speakers we hear from these days have an element of unquoted in their portfolios. The question is, do you have unquoted in the portfolio? And if not, is that a conscious choice? And what's the motive behind it?
Yeah, so at the moment, we don't have any unquoted assets in the portfolio. It's a conversation we've had with our board off and on, but it's something that is constantly being reviewed. We do have the ability to invest in unquoted as well, but we haven't made use of it in the last 4 to 5 years. And if we look at what has happened in private markets, I guess over the last 12 to 18 months, that opportunity set looks a lot more interesting now than what it did maybe a year ago. And so it's, again, something that we review together with the board constantly.
Thank you. And a really interesting question, I guess, is what the relationship between or why the trust has this element of emerging Europe in it, what the benefit of that is, and what are there any examples of how that has been beneficial, that you can provide that will help to explain why it exists and what the purpose of it is?
Yeah, so the trust actually was set up in 2004, and I guess if you think back to 2004, Europe was in a slightly different place when it came to expansion, and countries that were becoming part of Europe over time. And I guess the original remit was to create a vehicle that can capitalize on some of the opportunities that will come with that. And so it's based on the trust's history, and then over time, Sam, myself review the respective opportunity sets in our respective markets, and we can have up to 8, 10, sometimes 12% of the trust exposed to emerging European assets. And where we find opportunities, we often also found that they can be quite complementary to what we own in developed Europe when it comes to both the growth on offer, what's going on in some of those domestic economies, which can often be faster growing. And so we kind of think of it as nicely complementary to, I guess, what we do in developed Europe, also from a style and evaluation perspective, because emerging Europe has been a deep value market and has been a deep value market for quite a long time. And so it kind of pairs nicely with some of the best-in-class assets that we can find in developed Europe.
Thank you. A couple of questions have come in about the discount, about whether there is any kind of discount control policy in place, and if there is, what it is and how it works.
Yeah, so again, it's something the board takes very seriously, and we have biannual tenders and also share buybacks, and so the board actually has reviewed that again more recently, and we've been in the market buying back some shares to manage that discount, because we know it's important to our shareholders, and so it's again something that we review constantly. And when the discount moves out to wide, as it has done more recently, which is more of a reflection of what happens to Europe as an asset class, because we can see it across all the European trusts, the board takes action to manage that discount and bring it in. So that's the way we deal with that, really.
Thank you.
Sorry, call back. Bye.
When you buy a company, what is your target for it in terms of share price growth?
Sorry, could you repeat that question, please?
Sorry, when you buy a company, what's your target for it in terms of share price growth? Do you have a set target, or is it not that specific?
Thanks, bye.
Well, we don't necessarily target share price growth. What we're very clear on are the criteria I was talking about earlier. And then, we have a large team. We have, 20 investment professionals. We are one of the largest and best resourced European teams in the market. And so for every company that we own, we have our proprietary earnings model, our proprietary research. And, with that, we produce, our own numbers. We want to see, like, what gets me really excited as a portfolio manager is that if I look at our numbers relative to what consensus is expecting, where we materially above those forecasts, particularly in the outer years, it's very hard to be different in year one. But what we are looking for is for the earnings power of a business to be underestimated, in year 2, 3, 4, 5, and as and when our companies deliver on those forecasts, and we are fortunate enough to see those companies every quarter and have in-depth conversations with management teams, you typically find that the share prices do well as and when you see earnings upgrades coming through. So we have a fair value in mind. It obviously differs by company and by sector, but we're typically looking for that over delivery in earnings and cash flows, which then drives that shareholder value we talked about in the presentation.
Last question is about the energy transition story, which you talked about, and obviously you've talked about the speed of that being increased and brought forward by what's going on in the Ukraine and the kind of the cost of fuel as a result. But one question is, could sort of more populist views and more populist kind of politicians pushing back towards fossil fuels because they're an easier way out derail that potential?
Yeah, I think what you find right now is that in the very near term, clearly, countries like Germany needed to fix a potential energy problem, and you're seeing them going back to fuel times that we all thought might have been a thing of the past. But to us and to our mind, this is really only just a temporary feature, and what it absolutely does is kind of heighten the focus on where businesses and the economy should be going. And don't forget, actually, these decisions we're talking about, yes, they're supported in parts by government and European money, but the decisions are often made by private companies looking to make their businesses sustainable for the future, because many of them, particularly the listed ones, they are also now under scrutiny and are expected to disclose their scope 1, 2, and 3 emissions. And so again, when we speak to the companies, it's very, very clear that companies are adapting. They're adapting fast. They're looking for different fuel types, and then equally, they're accelerating that spend that was kind of thought about on a maybe 5 to 10 year view, and it's been brought forward because the payback periods have become a lot shorter, and the incentive is clearly there to move as fast as possible on that front.
Okay, thank you very much, Stefan. We haven't got any more questions, and we are just about to get to the end of the session, so we'll sort of end it there. We'll be hearing from Stefan's co-manager in early October when Sam Vett joins us for our first live event in London since before the pandemic, and we'll provide details of how you can access that later today. I'd encourage you all to sign up for what should be a fascinating couple of hours. In the meantime, Stefan, thank you very much for joining us and taking the time to talk to us today.
Thank you. My pleasure.
Bye.
Bye-bye now.